Hello and welcome to Talking Stocks. I'm Gugulethu Cele. Also in studio with me every week, I'm joined by Armitage and Bryan Rudd, both from Anchor Capital. Now they are the experts, and every week we bring you insightful analysis into both local and globally listed companies. And today we take a look at global fast food company Yum! Brands. This Fortune 500 corporation consists of brands such as Taco Bell, Pizza Hut and KFC. It's also home to the world's largest fast food restaurant company in terms of systems units. That is the Chicken Outlet there, which has more than 40,000 restaurants around the world in over 125 countries. Gentlemen, thanks for joining us today. I don't think I'm managing to grasp the size of Yum! Brands. We mentioned the number of countries that it's in, but it still doesn't make sense to me.
It's a very big business. I mean, if you sit and contextualize 40,000 stores, 125 to 128 countries around the world, that's pretty much in most countries. Most people know the brand, most people know KFC, most people know Pizza Hut. Taco Bell, a little bit more isolated to the US market, but a very, very big business. We were just discussing 40,000 stores, Famous Brands has over 1,000. So that puts into the local context 40 times the size.
And in fact, they're opening close to 2,000 stores in 2015.
Yes.
So they're basically opening, their new stores will be bigger than Famous Brands in the coming year.
That's a bit scary because maybe it goes back to the strength of their brands then, like the likes of
No, sure, they've got the big global fast food brands. In a South African context, you know, when we talk to Famous Brands, they always talk about if there was one business they'd like to own in South Africa, it would be KFC. But that's obviously got the ownership, you know, Yum! Own that, and Yum! Have similar businesses to KFC South Africa in kind of the rest of the world.
Looking at the overall global competitors, are McDonald's maybe one of those that compete with them?
Sure.
Yes. You know, when you look at these big fast food chains around the world, McDonald's and KFC are probably the biggest globalized businesses. McDonald's from a store count base, I think, is slightly ahead of KFC and Yum! Brands. But those are probably your two big global brands. And then you've got a few other ones from a Burger King perspective and a couple of other ones globally.
Let's get into some of the numbers now, the key metrics that you tend to follow with regard to the price earnings ratio as well as return on equity. Just looking at the PE, it looks a bit scary to me.
Yeah. This is one where it is looking a little expensive at the moment from a multiple perspective, but there's reasons for that. You know, when you're looking at a price earnings, you've got the price and the earnings both play a factor. Here, the price hasn't adjusted downwards as much as the earnings have fallen away. So that's blown out the earnings, or the price earnings a little bit to where it currently sits on a 425. Return on equity, though, is still an exceptional number, above 50%. So it really is a good quality business. They've got good margins. And as I said, a little bit of a yield to go in there as well.
I think what's important is, you know, at Anchor Capital, the way we look at a business and how we define it, and we say what's a good business. Yum! Brands is the example that we'd use. So you've got these big global master brands. 85% of their stores is effectively owned by somebody else. So you own the brand, somebody opens a store, they put the capex in, they take all of the risk, and effectively they're paying you a rental for the use of your brand and your product creation. So the returns at center are phenomenal. The cash flows are fantastic, and you get natural growth coming through out of somebody else putting their investment in. So a global franchise business is probably the best business you can find in the world.
It almost seems as though a lot of these franchisees that were based in China, looking at the revenue streams and where some of this money comes from.
You've got to be careful with this business because 85% of the stores are franchised. So if you franchise a store, you're only getting 5 to 10% of the revenue in. But of that 5 to 10% you're getting in, you're making an 80% profit. When you own a store, 100% of the revenue is coming in, but you're still making that 5 to 10%. So you've actually got to look at profits more than revenue. So in China, because it's new territory, they do own most of the stores, so the revenue is high. Outside of China, I think 6,500 of the 40,000 stores are in China.
Yeah.
So the 34,000 other ones around the world, they in fact only own about 15% of those. The rest are franchised. So China is a big portion of the revenue because they own all the stores. But from a profit point of view, they still make significantly more profit in the rest of the world to China. But China is obviously a very exciting growth part of Yum! Brands, although it's been going through some bumpy times in the last few years, which Bryan can tell you a little bit more about.
Definitely. Should we be kind of worried about China?
I don't think so. I think they've had a few problems there, and they seem to incur more problems. But I do think it is an area where they can overcome these. If we look back a couple of years ago, they had a problem with steroids and that being used in the chickens. Earlier or middle of this year, there was a problem.
Strong chickens.
Yeah. Middle of this year, they had a problem with one of their suppliers, a company called OSI. But this was not, that supply problem was not unique to Yum Brands. So although their share price took a hit, these guys supplied McDonald's, Burger King, McDonald's, all the chains. So it impacted everybody from a Western supplier perspective. And then literally in the last couple of days, China said, right, they now need to inspect all their stores. But they've managed to overcome these. And management is very much involved in the territory. They are very much involved with the regulators to get things back on track. It just takes a bit of time to wash through. They themselves have said they expect 6 to 9 months. So we're looking first quarter in 2015 for this to kind of stabilize and to wash through. So they have had a few problems in that specific region. They are classified as a bit of an emerging market company because of that exposure to China. But I think it's one they're working to overcome, and I think they do have the ability to overcome it.
But you must put this one in context. Chinese people love Kentucky Fried Chicken. Yes. They're opening 2 new stores every day in China.
2 new stores every day in China?
They'll open 700 stores in 2015. They've got a base of just over 6,000 now. So it's if you know, they're having some short-term wobbles. But if you take a 5 or 10 year view, you're going to have 15,000 stores in China. It's going to be more than half their profits. And in fact, you know, so the multiple looks high because they're having those issues because the earnings are down a bit. But if you've got a long-term view, you want to buy great companies when they're going through some wobbles, as opposed to great companies that are doing superbly and you're paying the top dollar for it.
And that's it. I mean, if you go and look at the Chinese consumer, they did a whole promotion incentive in October, November, and the sales went through the roof. It increased by 8% during the month. So people are there, and if you've got the promotion and the incentive to go, people are going back to the KFC brand and going back to the stores. Some people are still hesitant, but there is some people coming back to the brand. So we do think it's still got a very good opportunity in the region.
If we can take a local spin on the emerging markets theme, looking at the difficult year graph that was up on screen a moment ago, there was a significant emerging markets sell-off. And in South Africa, we have Pizza Hut being the new entrant into the South African market. Is that, again, another opportunity for them where KFC has done well? Now they're going to bring Pizza Hut or any of the other brands into the mix?
Sorry, Peter. Pizza Hut was in South Africa many years ago. Then they pulled the brand and they've just recently reintroduced it. I think it'll take some time to see whether that's enough to, I mean, pizza space is a very competitive space. And I think there's only a handful of Pizza Hut stores locally. From a Taco Bell perspective, it really is aimed at more of a different demographic. So that is very much US concentrated. Peter, you want to say?
Yeah, I mean, South Africa is really irrelevant for Yum Brands. You know, South Africa is 1% of the world. They've got a great KFC business here, but it's not going to determine their future. And
the rest of the continent, though, Peter, because we always hear about this emerging middle class in Africa.
Yeah, I mean, and I think, the rest of the continent collectively is a fraction of South Africa. Certainly, from a future perspective, it's where they want to grow into. But if you look at famous brands from a South African point of view, Africa's 10% of their store base. That's where all the growth will come from. And if you take a 10-year view, there's no reason that shouldn't be bigger than South Africa. But I think the African continent is a small opportunity right now, but probably one of the opportunity with the fastest growth rate. So it's something they want to focus on. But in 20 years' time, Africa still won't be 5% of their profits, I wouldn't imagine, because they're so dominant in America and from a market share point of view. And they've now got a big base in China that's growing at a hell of a clip. So, Africa is probably where China was 20 years ago.
Just the macroeconomic elements that we've heard about China slowing down slightly when it comes to growth. The US is expected to pick up. Will those play any elements on how much money the consumers have in their back pockets to buy KFC and pizza?
I think firstly, if you look at the US consumer seems to be in a very strong position at the moment. They are growing quite rapidly, and the consumer does have money. The gas prices also help there a little bit, but not as much as it used to. And then if we go and look from a macro perspective in China was growing massively from an industrialization perspective. They're now putting a lot of focus on consumer. They're looking for the consumer to spend. They're trying to give that incentive. Banks are getting encouraged to lend, online purchases through Alibaba, etc. So China from a consumer, I think, is an exciting prospect. from a macro, yes, they are slowing down, but I think they're encouraging the consumer to spend. So it runs perfectly in line with what we're looking at here.
Perfectly in line with what you're looking at. Brings us to the big question, the all-important one, where we get our experts to give us their perspective on the stock. Buy, hold, or sell? The all-important question, buy, hold, or sell, Peter?
So this is a share which is quite expensive and is going through some troubled times. It's a good time to buy, but you won't necessarily get a fantastic return in the very short term. It's in our portfolios. It's a great 5 to 10 year share, but you've got to be prepared to stomach perhaps a bit of flatlining in the very short term.
Brian, I'm sure you certainly agree.
Very much so. You've got a very good quality business here, global revenue streams. Recently, the share price has pulled back a bit, which I think does give people the opportunity to get in.
So get in and hold it for the long term. But what about management, especially the CEO, David Wawak? Yeah, he seems like quite an interesting character and has been inside the firm for quite a while.
Yes, he has. He's actually stepping down at the end of the year, or the end of the financial year, and will be replaced by a gentleman named Greg Creed. Greg Creed is the previous head of the American division. So he's very versed, very experienced within the business, and I think it brings a new life to it. It has been run very well, but I think the new blood will actually just take it that little bit further, enhance the strategy, and hopefully enhance the returns to the shareholders.
What are the new challenges standing in their way?
I think largely it's a very competitive space. You know, if you go down a road in a fast food road in a mall in America, there's going to be lots of different choices. So you've got to keep on top of your game. It's a great business model, a great brand, and they've got great brands. But if if your menu goes off kilter, or you're not giving the customer exactly what he wants, and that's something that always amazes me is when you go into a KFC, and I've been into one once or twice before, Gugu. The brand and the offering, you go, they're selling chicken. There's always something new to buy. So innovation, in fact, internal issues, innovation and new product is the major issue. They've got the brand, and then really just keeping that Chinese juggernaut. You know, for 10 years, Yum Brands is a fantastic share. It's only hit wobbles now. But keep that Chinese juggernaut going. And if they can maintain the growth trajectory, work past the issues they've been with, it's going to be a fantastic initiative.
One for the long term. So who needs spring rolls when you can get chicken wings, huh? We'll leave it on that note. Thank you so much for joining us, gentlemen. I'm afraid that's where we leave it for this week. But do catch us again next time where we talk more stocks. Thank you.